What's up, everyone? My name is Ale. Welcome back to my world of stocks. Today, I'd like to introduce you guys to a new series that I'll be doing on the channel. I know times are kind of shaky right now, the economy is not looking so good, but as a result, the stock market is going through a ton of volatility, and I actually think that there's some really good buying opportunities that are opening up right now through this volatility if you're thinking long term. So, in each episode of this series, I'll be picking 3 different stocks that I think are long-term buy and holds at today's prices. And every single one of them will be down a huge amount from their highs. In fact, in today's video, we've got stocks that are down 20, 40, and even 80% from their highs. Pretty crazy. And the other nice thing is that every single one of these stocks will be a company that is either already dominating or at least has a very big opportunity to dominate their respective market in the future. So when we look back at our investments, we have a good chance here of owning some of the biggest market leaders over the long term in their respective sectors and industries. But it doesn't even stop there. To make things even more fun and interesting in this series, I'm specifically choosing one low risk stock, one medium risk stock, and one high risk stock. So you'll basically get a wide variety here in terms of risk versus reward, depending on what exactly you're looking for specifically. Good chance that you'll find it here throughout this series when we do each episode consisting of 3 stocks per episode. So as you can probably tell, I'm pretty excited about this series. I hope you guys enjoy it. I think it's going to be a lot of fun, and I can't wait to share with you guys the first episode here. So let's go ahead and start. We'll run through stocks number 1 through number 3. And by the way, if you guys have any other fun ideas for different series to do on the channel, let me know down below. I'd love to make those videos for you guys as well. Or if there's any stocks that you want me to mention in this series, let me know that as well. But enough with that. Let's go ahead and jump into the first 3 stocks here in this very first episode of this series. All right, guys, so starting with stock number 1, that's going to be our low risk option. And for that, I'm going with the dominant leader in e-commerce with Amazon, ticker symbol AMZN. And the reasons are pretty simple. Last year, Amazon hit a new record high of US e-commerce market share at nearly 57%. The next closest competitor is Walmart at just a single digit 6%. And even if you break Amazon apart from their third-party marketplace and their first-party retail business, both of them, again, third-party marketplace, that's where you have like outside sellers. First party, that's where Amazon is directly selling the stuff themselves. Well, even if you break those 2 apart, both of them would still easily come in at number 1 in market share, and it's not even close. But the dominance doesn't even stop there. Amazon also controls the most cloud computing market share, a market that is already worth close to $200 billion, and it continues to see high growth every year, with AWS at about a third of the entire market in the whole world. Only Microsoft and Google give it any kind of a real challenge there. And finally, Amazon also has reached a double-digit percentage of the US digital advertising market, with only Google and Facebook ahead of them in what is essentially a duopoly that has slowly been turning into a triopoly with the addition of Amazon. The dominance in these 3 key gigantic markets has led to unbelievable financials for the company, with sales that are quickly approaching $500 billion a year. It's freaking crazy. Profits are a lot smaller at $33 billion of net income, but that's mostly because they always consistently reinvest their profits back into the business so that they can achieve more growth in the future. They're always just kind of having a long-term mindset of dominance. But speaking of which, despite that already gargantuan size, when looking at growth, their revenue growth is still projected to be in the double digits both this year and the next at over 15% and 17% respectively. Meanwhile, the stock is actually very reasonable right now because of a recent dip, and maybe I should use the word dip very loosely here because the stock is still up almost 250% in just the past 5 years, but more recently it did drop by about 20% from its highs, which is generally considered a bear market in the broader sense. Some people even consider that a small crash. Now, I wouldn't go that far with Amazon here just because it was already so high to begin with, but I do think that this is a very nice dip, or at least think of it as a dip or maybe a correction, and I think it's worth jumping in at this price for one of the best companies in the world. And for what it's worth, out of more than 50 different analysts on Yahoo Finance, they have low, average, and high price targets of around 3,000, 4,000, and 5,000, while Amazon stock itself is currently next to the 3,000 mark. So significantly lower than most of those, targets. More recently, too, Amazon announced that they'll be doing a 20-for-1 stock split this year, which should excite investors considering the last 3 times that they did that, the stock skyrocketed by nearly 50% within just weeks following the split. Now, that was a long time ago, and I highly doubt that anything like that will happen this year, but it may at least attract some new investors that prefer the lower price per share. And don't be so fast to dismiss Amazon as being too large to keep growing over the long term. They've shown a huge willingness to expand into many more markets in the future, like for example, with their acquisition of Zoox for the self-driving market, their acquisition of MGM that provides more content for their Prime Video in the streaming video market, and they're even launching a new Lord of the Rings series to attract even more viewers as well. They've expanded into online pharmacy with the PillPack acquisition. They've got telehealth with Amazon Care, and they're even going into robotics after launching their first home robot last year. Add everything up, and I just think that Amazon is a stock worth holding well into the distant future and even at today's prices. All right, now moving on to stock number 2, that's going to be our medium risk stock for the day. And here we're going to jump into the artificial intelligence market and go with one of my personal favorites in NVIDIA, ticker symbol NVDA, who is a very dominant player in several different markets, but that is especially the case in anything surrounding AI, where NVIDIA technology powers nearly 70% of the world's top 500 supercomputers using artificial intelligence to make faster decisions and discoveries, many of which rely on powerful data centers to transfer and process all of that data, of which NVIDIA GPUs control over 80% of that AI data center processor market as well. But it doesn't stop at hardware. NVIDIA also has evolved into a very strong software provider, like with, for example, their AI Enterprise Suite that offers all kinds of different tools and applications and services to help corporations implement artificial intelligence into their own businesses. And there will be huge growth to be had in future waves of artificial intelligence, like for example, robotics, autonomous driving, and smart cities. Those are some of my favorites, especially, I would say primarily smart cities. I think that's a market that I feel people are not paying enough attention to, but it's going to be huge in the future. In fact, Allied Market Research predicts that the global smart cities market will be worth over 2.4 trillion with a T, trillion dollars by 2025. Now, for context, Nvidia only did less than 30 billion in sales last year. And we'll come back to the financials in just a second, but these are markets that Nvidia is already investing heavily in with, for example, their Metropolis platform for smart cities that can collect and analyze data from trillions. It can do trillions of AI and Internet of Things devices, taking data from all of them and solve all kinds of challenges. Their Drive platform for autonomous driving already has close to 400 different partners and customers. They even have their Isaac platform for autonomous robots that helps with all sorts of different things like automating manufacturing, recycling, cleaning. They even help with autonomous deliveries and a lot more. These are all markets that will experience tremendous growth in the future, but you actually don't have to look out very far into the distant future to already see that growth with Nvidia. Sales grew by monstrous over 50% in 2020, over 60% in 2021, and they're still expected to grow by nearly 30% this year and another 17% next year as well. As you can see, their business can be a little cyclical at times. And right now, with all the semiconductor shortages and issues that are, all kinds of different issues, supply chain issues, disruptions, all kinds of things going on in the world. But you couple that with 2 monstrous years that they have to compare to. And yeah, their sales growth is going to be cooling down a little as a result, this year and the next. But during this time period right now where things are slowing down, well, the stock has crashed by nearly 40%, which admittedly is a little difficult to see on this 5-year chart given that they're still up by close to 800% during that time, which is one of the reasons why I never really considered Nvidia to be a cheap stock to own just because it's always climbing by such large amounts. But guys, with a drop of almost 40%, if you're thinking very long term like I am, then I think it's an absolute buy and hold on this dip. I mean, I really like Nvidia. All right, now Moving on here, that leaves us now with the third and final stock on the list, which is also our high risk pick of the day. And for this one, we're going to go with a company that has a very real shot of dominating, or at least super heavily competing in the future of healthcare, specifically the telemedicine market, which is where I see most of the growth in that broader market going over the long term. And that company is, of course, Teladoc Health, ticker symbol TDOC, who admittedly has been a very bad performer for me, but I'm still a relatively new buyer in the stock, so I can easily keep buying more and lowering my cost basis. It's really not that bad for me. But before we look at the stock, I'll just mention a couple of highlights of this company. By offering various hardware and software solutions, Teladoc has been able to help doctors treat their patients virtually through phone and internet, and they've done such a good job of that that it's led to the most market share in the US telemedicine market. But the cool thing about Teladoc is that they only have around 13% of that, with the majority of the market still consisting of a ton of smaller local players or the practitioners doing it themselves. But those are nowhere near as experienced or robust as what Teladoc offers. So it ultimately means that there's a huge market here for Teladoc to sell their services to. And speaking of that, that market is expected to surpass $636 billion by 2028 with a compound annual growth rate of north of 30%. So for context, Teladoc only did about 2 billion in sales last year. So the market is like more than 300 times larger than that. And it's already translating to very high growth for them, with typically the same revenue growth as the broader telehealth market at around 30% or more. Now, 2020 and 2021 were extraordinary years because of the pandemic. Things were locked down, people were turning to more virtual options. So that growth is going to be a little lower here in 2022 and 2023, just because it's a very difficult comparison. Things are opening back up, it's kind of obvious. Growth is not going to be as high. But by all accounts, this is still a company that is absolutely heading in the right direction. And yet, despite that enormous growth brought on by the pandemic, the stock is actually trading even lower than it was before 2020. That's unbelievable considering how much larger they've become as a company since then. This is a stock that I really think people have become way too bearish on, as it's currently down, get this guys, a monstrous nearly 80% crash from its highs. I mean, I get that this is an unprofitable company in a fairly crowded market, but as the leader of it with very strong growth, they do not deserve to be down anywhere near this amount, especially if you're thinking long term. By the way, someone that agrees with me is Kathy Wood, who has Teladoc as the second largest holding in her flagship ARK Innovation ETF, only behind Tesla. And out of the 182 different trades that she's made on it through her various ETFs, only 2 of those trades were sales, and 180 of them were buys. So she's pretty bullish on it. And she's not the only one that saw an opportunity there. Out of the 27 analysts covering the stock on Yahoo Finance, the absolute lowest price target is right next to where the stock is already trading today. So there's significant upside to both the average target and especially the higher ones. I mean, at this price, get this, guys, at this price, you have to remember here that Teladoc recently acquired the chronic disease manager Livongo for over $18 billion. I think that was like in 2020, it was very recent. So $18 billion that they spent on this acquisition. But today, Teladoc's entire market cap is only worth around 10 billion after the crash. So in other words, Teladoc stock is literally worth close to half the value that they paid for the Livongo acquisition. That's insane. That's so crazy. Just a year ago, that market cap was closer to 30 billion. I mean, I get it. The world is opening back up coming off of the pandemic, and everyone is worried that the telehealth market will come to a screeching halt. But first of all, I really think that the world is going to keep using remote offerings for many different things in life, especially like in work and in this case, health, just because of the efficiency of it and the convenience of it all. But even besides that, Teladoc is a great company just on their own that continues to find new ways to inject growth into their sales. In 2017, only about 10% of Teladoc's members used multiple products from them, but in 2021, that percentage grew all the way up to 40%, meaning customers are choosing more virtual health options than ever before, and Teladoc is doing a good job of advertising their different services to them. And these are things that I just think are going to increase over the long term. So at today's rock bottom prices, I think it's worth taking the high risk on and buying and holding this stock super long term, because I myself, I might end up owning the global leader here of a gigantic market. And I would like to be able to say that I picked up those shares very early on and at these dirt cheap prices. But that does it for this episode, episode number 1. I hope you guys enjoyed it. We've got many more coming in the future. Let me know down below what you think about these stocks. Let me know if you agree with any of my picks. Are there any other stocks that you would like to see on this list? I may be able to include them in a future episode. And I will catch you guys in the next one. Thank you so much for all the support. It means the world to me. Hope you're all doing well. Take care. Bye-bye.